We're through inflation data. We're through a speech from Fed Chair Powell. And what do we have to show for it? Perhaps finally some clarity on stock markets. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to get ourselves ready for the last sprint into the end of this trading week. There's a lot to discuss. There's a lot that's on the menu, and the road ahead might just be getting a little bit more discernible, might just be getting a little bit more clear. So that's what we're going to unpack here as we look at what all of this has given us in markets so far and what may be next. We'll start right with the brass tacks. The next piece of U.S. data closing out the week, that's going to be the October U.S. retail sales report. The expectations here that we are going to get a rise of 0.3%. That would be a slight cooling from the prior month and well within the recent range of outcomes, as we can see here, right down the middle of the recent range that's emerged here. If we sort of look at the latter part of 2022 into 23, there's that big 4.1% spike there as we get some angling around the lingering effects of the pandemic. But soon enough, we settle into a range of basically between down 1% and up 1%. Over the course of the next almost now 2 years. And these outcomes that are on the menu here for October look very much in line with those kinds of dynamics. The issue here is perhaps less so what the number is. That's somewhat secondary. The main issue is what any number coming out of the U.S. and pivotal to U.S. economic growth is going to mean for speculation, and what lens will that number offer to ongoing dynamics. We can see here, this is a chart we reference all the time because it is a very, very powerful lens, not so much on where the U.S. economy is going, but on how speculative interest is shaped by U.S. economic data outcomes. It's quite different and very powerful because what we see here is that since late August, U.S. economic data has increasingly improved relative to forecasts. That doesn't mean it's been good, which it has. Doesn't mean it's been bad, which it has not. All it means is that it's been increasingly better than expected. And what that then does is inspires a repricing of baseline expectations about the trajectory of the economy, because people that are participating in shaping those expectations, economists, markets, traders, everybody with their hand on actually shaping market outcomes, they have to readjust. They look at numbers that do not comport with baseline expectations, and they say, well, our view of the U.S. economy needs to change. It must be different. We must be trending in a different way. Needless to say, an economy where numbers outperform relative to forecasts, you have a rethink of any dovish expectations you might have of your central bank. And that is precisely what we've seen from the outlook on the Federal Reserve. These are the numbers that we have in Fed funds futures currently. They anticipate a diminished chance of another rate cut in December, but that's hardly the main story. What is the main story is what is on the menu for next year. The markets are now pricing in barely 2 25 basis point rate cuts. They're allowing themselves a mere 30-ish% chance that there's going to be a third one at 59 basis points. So 9 out of 25 basis points toward a third cut has been baked in. But that, of course, is a far cry from where the markets were when the Fed issued its policy guidance in September, or even where the markets had been more recently than that. When we were about to get the start of Fed rate cuts, the markets envisioned 232 basis points in easing this year and next. When the Fed gave the first 50, that's this jump right here, this move, we essentially got to them saying there's going to be 100 basis points this year, 1% in easing, of which half was delivered in one shot, and a further 50 basis points delivered over November and December. They also put out the projection that there's going to be another 100 basis points, another 1% in cuts on the menu in 2025. Well, we have the one cut at 50 basis points. That's there. Just last week, we got to the next cut. That's here. That's another 25 basis points. So we've all but fully delivered on what the Fed had in mind for this year. And we have a slightly less than even chance now of seeing the fourth cut in December. But it is the outlook for next year that has undergone the most dramatic transformation. The markets thought we were looking at 125 basis points next year. The Fed thought we were looking at 100. The markets now see, as we just said, probably 2 with a slight chance of 3, 59 basis points. In other words, the path envisioned just a few weeks ago by both the markets and the Fed has been cut in half because the markets have looked at this economic data and said the Fed is cutting into an economy that is not trending down, but trending better. And what that trending does is it forces a rethink of expectations toward higher inflation and toward less scope for rate cuts. As a matter of fact, we just heard this today from Fed Chair Jerome Powell. He came out and once again, as we discussed on the show yesterday, as we anticipated, reiterated that the Fed is not on dovish autopilot, that they will go slowly on cuts, that there is no need to rush, that the economy is strong. Notice what has happened to expectations for December's policy meeting. This would be no cut. This would be cut. Yesterday, the probability of a cut was over 80%. Today, it's under 60. And so what we end up with, of course, is an immediate reaction from the markets. Is it any wonder that when the Fed begins to cut rates, what the markets do is go the opposite direction? Right here, this top in long-term bonds, this is where the Fed cuts 50 basis points and embraces all of the dovish myth-making that investors want them to embrace, with the 100 basis points this year and the 100 basis points next year. Shouldn't that mean interest rates go down? No. Because what the Fed is doing is happening not within a vacuum, but in the context of what the economic data is performing like. And since the Fed is doing all of this dovish posturing at a time when the data is getting better, not worse, the market says, oh, okay, you're pouring gasoline on a live fire. This will be inflation. This will mean higher rates downwind. Bonds come down, and precipitously so, and yields go up. Not surprisingly as well, that exact turning point is where the US dollar turns higher. This is a chart of the euro as a sort of stand-in for the overall direction for the dollar. And of course, what we find here is a situation where just as yields turn up, predictably enough, the US dollar follows because its yield advantage relative to other currencies improves. Not exactly the kind of thing that you might expect from a dovish message out of the Fed unless you took the data flow in context. Incidentally, it is the same thing as what happened toward the middle of the year, except in the opposite direction. Notice here, here's the beginning of the year. The markets anticipate 200 plus basis points in easing between this year and next. And then through to May, that outlook is diminished. It is diminished by, again, about half. What's going on at that time? Well, once again, look at the economic data. It is improving. The US economy is getting stronger since the beginning of the year and into March, April, and then begins to deteriorate before this next leg higher. We'll consider what occurs. This is diminished until the data starts to deteriorate. This is late March, mid-April or so, right here. But of course, by that time, the Fed is saying, oh, well, the economy is doing so much better, maybe we don't have to cut as much. What do the markets do? Do they respond to the Fed saying, oh, maybe we'll only do one cut this year, as they said in June? Or there's been a lack of progress on inflation, as they said in May, because the economy's been hotter? No, quite the contrary. As you start to get from mid-April, give or take, the economic data getting worse, you also get more rate cuts getting built out. You also get, from that very same spot, higher bonds and lower yields, and a weaker US dollar. And so the dynamics here seem clear enough indeed. If we were, going back to the subject in question here, get a hotter retail sales number, it wouldn't so much be the retail sales number this way or that would be the story. It would be that yet another piece of U.S. economic data has given the Fed reasons to back away from cutting rates next year. Retail sales, of course, is no small thing. Household consumption is overwhelmingly the driver of U.S. economic growth. So if this is strong, then the U.S. economy ought to look strong and ought to remain on this path to higher rates. Where this becomes a problem, and obviously we see this as having significantly bolstered the situation in yields, significantly bolstered the situation in the dollar. We might well, were we to get an upside surprise here, get continuation in that direction. But the issue has been, what about stocks? Stocks have been relatively resilient in the face of this so far, much as they were toward the beginning of the year when this readjustment was occurring. And that's because the markets are figuring, well, if the U.S. economy is strong, then perhaps things are going to be okay. This is not a dropping out of rate cuts because things are behaving badly. This is a dropping out of rate cuts because the economy is performing well. Surely that's not bad news for corporate earnings and for stock markets. Well, maybe so. And at the beginning of the year, in the first quarter, that certainly was the story. It may not be that this time. And the key difference here seems to be what's going on with global growth. At the beginning of the year, global growth was firming in tandem. This is the Purchasing Managers Index from S&P Global and JP Morgan. As ever, this functions around 50 as neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here, here's January, is the global economy is on its way to hitting a 12-month high on growth in May. It is accelerating. So as the US is accelerating, so is everywhere else in aggregate. It is a very different story now. The US is indeed strong, it is accelerating, but the global economy has been slowing since May. Moreover, in September, it hit an 8-month low on growth, and October only saw a mild rebound. This, of course, is very challenging in an environment where the ubiquity of the US dollar, as we've said many times here on the show, according to the data from the Bank of International Settlements that tracks these things, close to 80 to 90% of global monetary transactions are settled in the US dollar because of its absolutely unrivaled liquidity. Even countries trying to transact between each other and not with the US can find it cheaper to transact first from their currency into dollars and then into whatever other currency they want rather than bilaterally, because the dollar is just so liquid and so ubiquitous in global commerce. What this means is that when the Fed is expected to be stingier with rate cuts and yields rise, that doesn't just increase the cost of borrowing of dollars. In increasing the cost of borrowing in dollars, it also increases the cost of borrowing, period. Full stop. Everywhere. Because dollars are the ubiquitous medium of exchange. So when you get this rise in US rates right here, you also get a rise in global rates. This is an average of Germany, the UK, Australia, and Japan, just to give a sense of the major economies. Moreover, we're going to get data over the course of the next 24 hours that may reinforce this. Needless to say, we're biased higher, seemingly at least, for an upside surprise on retail sales, but we're also going to get data out of the UK, where we are looking for GDP to accelerate from 0.7% to 1%. And here, the path of economic surprises has pointed in the wrong direction. Here, things have been deteriorating, implying there's a downside surprise risk here. Likewise, we're expected to get economic activity data out of China. Industrial production and retail sales both seen posting slight improvements in October. And the story may well echo the numbers we got last week from China's trade report and Caixin PMI data, which on the one hand showed that export demand was surging, while domestic demand remained anemic, and tied that surging export demand to something very short-lived, expectations that the incoming administration in the U.S., the Trump administration, will slap tariffs on China, and indeed will slap tariffs on everybody, but single out China in particular, and that importers then that are going to be struck by this, because make no mistake, it is importers that pay tariffs, not the country of origin. There's no way for one sovereign country to coerce another to pay a tax. That's not how taxes work. What the tariffs do is they impose what is essentially a sales tax on imports. And so importers that anticipate they are going to face higher tariff barriers and therefore face higher costs to import things from China, they've apparently rushed in to try to build up as big of an inventory ahead of this as they can. They're trying to front run the tariffs. So what you might see here is robust industrial production growth that could surprise higher, but anemic retail sales, which might surprise lower, following on from another soggy set of consumer price index numbers out of China released over the past weekend. So on balance, you might end up with strong U.S. retail sales, a weak story on GDP out of the UK, and an ephemeral story out of China, which ultimately yields back to an economy that hasn't done much by way of growth since emerging out of COVID restrictions and is looking at now 6 consecutive quarters of economy-wide deflation, implying there is no demand to speak of. All of this, of course, makes this situation more acute. We just got U.S. CPI data earlier this week, which underscored yet again that U.S. spending is focused on the domestic service sector. The firms there are not going to spill over by way of demand to global markets. U.S. Imports are focused on goods. So U.S. Vigor is not extending to other economies because most of demand is on domestic service goods and domestic service firms, whereas global firms that import into the U.S. are largely not seeing it, which is why the global economy is slowing, even as the U.S. is as strong as it is. That would comport with strong retail sales numbers, but also with ongoing divergence where Europe and China, the other major engines of growth, continue to be anemic. And that's certainly not a happy thought at a time when this dynamic, because of the repricing of the Fed, means that those anemic economies have to face the chokehold of rising borrowing costs. And this is where the situation gets spicy for the stock market. We saw this week stock markets wobbled the day before CPI around speculation that the number might be higher than expected. It wasn't. It came out exactly in line with forecasts, but also marked the fourth consecutive month that disinflation didn't happen, and thereby encouraged a combative Fed. When we got the Fed chair, Jerome Powell, speaking today and channeling that combative mood, stocks fell. So there is seemingly the early sense that stock markets are getting worried about this, and of course they are. If we get a rise in global borrowing costs, even as the global economy slows, the improvement in the global debt to GDP ratio, this thing right here, that makes this growing pile, and indeed a record pile, of global debt more digestible and more financeable, that might be going away. The bout of inflation, if it had one positive, was that it helped inflate away a bunch of this debt burden, making it easier to surface. Well, it'll be much more difficult to service if this starts to go the other way, stressing credit markets and economies and market-wide sentiment. This may well be what stock markets are finally going to get afraid of. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow. And again on Monday, I'll be on with Victor Jones and Tom for First Call on Sundays, back with Victor for The Price of Truth on Wednesdays, writing for the News and Insights portion of tastylive.com, and commenting on the platform formerly known as Twitter and on Blue Sky, both at Ilya Spivak. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Take care.